All right, welcome everyone. Today is January the 20th, 2019, and this is the G&G Associates 2018 and 2019 Tax Update Training Webinar. All right, so for those of y'all who don't know who I am, let me tell you a little bit about myself. I am president and owner of G&G Associates Tax, Financial, and Veteran Consultant Services. I'm a retired Air Force officer and have been in the business as far as tax and financial consulting services for over 18 years. And what sets our business apart from other businesses is our tax and financial consulting knowledge and experience. Today, I'm going to concentrate on the tax and financial consulting part of this part of our business. But what sets us apart is that you might have been in this situation yourself where you've gone to a tax advisor and you've had some financial questions and they say, you know, you bought in your investment portfolio or whatever the case may be, and they say, well, we can't really answer those questions at the moment. You might want to go talk to your financial advisor, or vice versa. You've gone to whoever you use as a financial advisor, if you have one, and they start asking you about taxes. Maybe you took your money out of your 401k or any kind of investment, or you sold an investment and you've got questions about what's my tax obligations for this to whoever your financial advisor is, and they go, well, you need to go talk to your tax person. Well, that's one of the benefits of us. I am a financial and tax consultant, so with that aspect, I know both sides of the house, because to me, honestly, you can't say you really don't understand finances and do taxes, or and vice versa. You're supposed to be a financial person, not understand tax repercussions of that, because both deal with your investment potential and your future rate of return and how much you save and make money in the future on your investments, and that's very, very important. And that's why I actually started studying and wanted to make myself become wise on both sides of the house. As a matter of fact, how I got into business, because I was just worrying about my own tax obligations and my own financial investment portfolio, which turned around into me actually ending up doing the business. Now, today's presentation, I wanted to go over some of pretty much I wanted to make this an update, tax training, and then business development. And what do I mean by tax updates and business development? Well, you'll see as we talk about the tax situation initially, and then we'll see how that is going to affect your business. And when I say your business, managing your business, what you do after you get off the job, if you still have a job, or if you're unemployed, if you self-employed, managing your job, which is self-employed, and then hopefully to expand on your business. Well, let's talk about some of the tax changes, and I'm going to start with the individuals and families part of this, because everybody's going to be affected this, whether you have a business or not. You do have an individual or a family tax obligation. So let's talk about some of the big changes that came with the Tax and Jobs Act that just came out in 2018. Most folks have heard about a lot of the different changes, but really don't understand what's going to do and how it's going to impact their tax situation here when they do their taxes here within hopefully the next couple of months. All right, so one of the big changes is the changes in the tax bracket rates. So you can see right here, I've given you the tax bracket rate. There's some few new rates that came in. For instance, there was no 12% before in the past. It was only 10 to 15 and straight to 25, but you can see they've broken this down into more tiers. We got now 10% bracket, a 12% bracket, 22% bracket, and so on, being the highest tax bracket at 37%. Now, this tax bracket deals with federal taxes only. It does not include your state taxes. So whatever your state tax, if you have a state tax obligation, you can go ahead and add that to whatever number you see here for your federal tax bracket. One of the other changes that came about is the increase in the standard deduction. All right, so this is one of the things that most people usually don't really understand the difference in. What is the difference between standard deduction and itemized deductions? Well, standard deduction is pretty much just what it says. It's a standard deduction based on your tax filing situation. So we see here, these are the three tax filing situations. You're either filing married, filing joint, head of household, or single. Now, one of the big changes that came about, you might say, well, what happened about married filing separate? Well, married filing separate falls under the same category as single. So if you're thinking about that, you're married and you're filing separate, maybe it's because of divorce, or you have an obligation because maybe your significant other has some type of taxable or financial obligation that you don't want to mix your taxes in with them, then you will be falling under the single status if you're married filing separate. But you can see right here in this table, the big difference between the filing status from 2017 to 2018 and now in the current year, 2019, and hopefully you'll be preparing for that if you have not done so already. All right, so married filing separate is almost a double. It almost doubled in the standard deduction from 2017 to 2018. Head of household did about the same, almost doubled, as well as single tax filers have almost doubled. You see they got a new little nomenclature down there for single filers over the age of 65. They can claim an additional $1,600, and married filers over the age of 65 can claim an extra $2,600 on top of these standard deductions that you see right here. All right. Now, some of the other changes that came about is the suspending of the personal exemptions. I don't know if you all are really familiar with that, but definitely go back and look at your past tax returns, where pretty much the way it used to work was not only did you get the standard deduction, but if you not only had other dependents in your home with yourself as well, you got to get a separate personal exemption in addition to your standard deduction back in the past. Well, with the new Tax Job Act that came out here in 2018, they have suspended all personal and dependent exemptions. So you no longer get a personal exemption for your children, yourself, or anything like that. It got addition. And how effective this is, how big a change is that? Well, look at it this way. If you had a family with a husband and wife, so you take 4,040 that you see here, you had a husband and a wife, right there it meant $8,100. Now maybe you had two children, add another $8,100. That would come out to be about $16,200 standard deduction included, plus the tax exemption. In addition, you would have gotten for your dependents in your home. So what happens is now that $4,050 per dependent or spouse or taxpayer in the home has gone away. All you pretty much get is the standard deduction, which you talked about in this slide right here. This is pretty much all you're going to get as it doubles. So it really depends on how many people you had in your household that year. If you were maybe a single person, not a big deal. But if you were a married couple with multiple dependents that you were claiming, that could be a big difference in your deductions that you would get. All right, now, also starting in 2018 is the phase out of the personal exemption and standard deduction for married couples with adjusted gross income above $313,000 and singles above $261,000 for those who receive, and you will get a higher one for those with tax credits in 2018. So the tax credits may offset some of these personal losses for your family. So now let's talk about these tax credits. Some of you might be familiar, I'm sure. Those of you who have children are familiar with. Some of you who do not have children or maybe single filers, you know, there's an option out there where you can get a child tax credit, or you can get a tax credit, an additional child tax credit, or earned income tax credit, or even some other credits out there as far as educational tax credit. Well, right here we're talking about a child tax credit. Under the 2018 tax reform, as you can see here, the child tax credit would be worth $2,000 per qualifying child. And the age cutoff remains at 17, but the children under the age of 17, the end of the year's taxpayers are able to claim that credit. Now, up to $1,400 of that credit may be refundable for each qualifying child as an additional child tax credit. So you might get an additional child tax credit as well if you meet these phase out, or if you meet these income restrictions for your total family household. And these income phases or income restrictions start to phase out as your income starts to increase. If you're a single filer or a head of household filer above the income bracket of $200,000, or if you're a married couple at $400,000, they start to phase out. If you don't understand what phase out means, pretty much then now, if you were to get $2,000 per child, as your income starts to increase above $200,000, if you were a single filer, or a head of household filer, because you wouldn't be single if you had a child you were claiming, a head of household filer, then that starts to phase out. That $2,000 credit starts to reduce itself until it phases out up to the certain income brackets that go from beyond that point. All right, so that's that. Again, if you have any questions, feel free to just text that number down here, and then I'll be looking out to maybe answer any questions throughout the presentation. All right. Limiting or discontinuing certain deductions. Now, I'm going to go over the most notable deductions that may have been affected that most people, and I'm just going over the most common deductions I have seen from my tax clients over the last 18 years that I've been doing taxes. So I wanted to kind of give you an idea of what really happened with the Jobs Act here. So home equity loans and interest. The new tax law generally limits the deductibility of mortgage interest now up to $750,000 of debt used to acquire your home. The new rules allow deducting the interest on home equity loans used in many common transactions. What does this mean? So pretty much if you had a debt obligation of $750,000 or less, then you can continue to deduct your interest from your home equity loan and any other mortgage interest at that time. Though once your debt obligation goes above $750,000, then you will not be able to deduct any of that interest above that amount. Now, also, one thing that really changed here is because a lot of times, especially where we have college students, a lot of families and homes, a lot of families will take out any maybe equity they maybe had in their home. They might have used that equity to pay for college or deduct some of the tuition or pay off some credit card debts or things of that nature in the past, and they were able to deduct that interest that they took out from that home equity loan to pay off those debts. Well, that has gone away. The IRS is not allowing you to use home equity lines of credit for any of those circumstances. The only way you're able to and still be able to be able to deduct that qualified interest. Okay. So, but however, if you took the loan out to improve your existing home, and you see right here, or the interest will be deductible. So pretty much the only thing you can take that home equity line of credit out for now is to improve your home. You can no longer take that interest out to pay off other debts or college tuition or things that a lot of families were doing in the past. Okay. Let's move on. Number 2, moving expenses. This is a big one. I usually have probably about 10 to 20% of my clients take this moving expense or had taken this moving expenses in the past. But right now, moving expenses pretty much essentially is gone. Unless you're in the military, and that's active duty military, you see here members of active duty military, then you no longer can deduct your moving expenses. All right, so as you can see here, 1.1 million taxpayers claim this deduction in 2015, because that's the most current number the IRS has for the statistics. In 2015, 1.1 million taxpayers claimed this deduction would save them about $3.7 billion. So now that deduction is pretty much gone away, unless you're active duty military. Now, on the flip side of that, if your employer pays moving expenses because your employer moves you from whatever, East Coast, West Coast, or wherever destination greater than 50 miles from your previous location, if your employer pays for you to move, it used to be not something that was considered taxable income. So what happens now, if your employer pays for your moving expenses and you're not in the military, your employer now has to include that as income for you. So not only do you not get the deduction anymore, but if your employer pays for it, it's going to be considered income to you on your tax return. So that'll be extra income that'll be reported on your W-2 if you were an employer and someone pays for your moving expense. Now, your employer gets to deduct it. The person with the business, they get to deduct that expense, but you will not be able to deduct it no longer on your taxes, anything above that, and you will have to pay tax on that expense. All right, number 3, the jobs expenses. All right, the deductions you claim for the cost of things, and this was a big one for a lot of folks when they start talking about itemized deductions. All right, so itemized deduction is the difference between standard deduction. So earlier we talked about standard deduction where the IRS pretty much just give you a standard deduction based on your filing status. Well, now these are starting to go into some of the itemized deductions that taxpayers used to be able to claim in the past. So in this case, if you had in the past, for instance, when the standard deduction in 2017 for a married couple was $12,400, if you had itemized deductions, that's mortgage interest, personal property taxes, state taxes, donations, charitable contributions, some of job expenses as we talk here, if those expenses exceeded the standard deduction for that example I'm just using for a married couple, if it exceeded $12,400, then you were able to itemize and get a larger tax deduction than you would had you taken the standard deduction. But in this case, what's happening is the IRS has increased the standard deduction, but now taken away a lot of the itemized deductions that you have been able to claim in the past. So more than likely, those filers, and pretty much it was around 30 to 40% of people in the United States file itemized deductions. The majority of folks file standard deduction anyway, but now those numbers are really going to reduce for those people who itemize, because you're really not going to get to deduct a lot of the things that you were able to deduct in the past, because you're not going to meet that deduction threshold more than likely to be able to itemize. So that's part of their saying they're simplifying the tax code. That's what they're trying to do. And that's, here and now, because if you look at the tax form, it's now, if you look at it, you only got one page to the 1040, but what they did was added a whole bunch of other worksheets and schedules. So to me, it feels the same amount of pages because they just added additional schedules and worksheets. But let them tell you it's simplified now, but all they've done is pretty much giving you a standard deduction and taking away a lot of deduction. But to me, it still have same amount of forms when you still got to fill out certain other things if you have these other expenses. Now, with the Job Expenses Act, these things used to be able to deduct, such as you can see here, licensing and fees from, maybe you might be a medical professional and you got to keep your currency up or your fees up for, if you're some type, some kind of career that requires you to get licensure, clothing, tools, equipment, unreimbursed, continuing education. A lot of folks like myself, we have what you call continuing educational credits. Even if you are an employee, sometimes you have to take those classes to keep yourself licensed up to date in your continuing training so you can keep your license. The deduction costs are only allowed to the extent that these costs, when combined with other miscellaneous expenses, exceed 2% of your adjusted gross income. Because your employer can deduct these costs, consider asking them to go towards these expenses. So pretty much now, since you're not going to really be able to deduct these expenses too much and you're not really going to get it, now you might want to now negotiate with your employer to maybe consider helping you towards paying these expenses, so you're not going to get them no more as a tax break. All right. Now, tax preparation fees. That used to be something you'd be able to deduct, but guess what? As you see there, that's no longer allowed. So those tax preparation fees that you used to be able to pay to your tax preparer or consultant, then you no longer be able to deduct that now in your 2018 and beyond taxes. I think that's kind of self-explanatory. Don't need to go more into that. Some other notable expenses here, other miscellaneous deductions. The list of other deductions, right, you see here, you used to be able to deduct your advisory fees, investment-related fees, credit card convenience fees, IRA account fees. This could be huge depending on what type of account you have. For those of you out here who have managed funds, those managed fund fees that you used to pay, or they call loaded fees, those used to be tax deductible to you. This could be huge, but now they're totally not deductible anymore. Of course, they were subject to the 2% of your adjusted gross income, but depending on how large your portfolio was, that could be a huge amount. So, for instance, if you had investment fees and you had $200,000 in your investment portfolio and you were paying your investment fund manager somewhere between 2 to 3%, which is pretty standard, you're talking about now a $4,000 to $6,000 deduction that you no longer will be able to get as your miscellaneous fees deduction. So there you go. That's now gone away. Number 6, parking and transit fees. I got a lot of clients that work in the DMV area, the D.C., Maryland, Virginia area, up around D.C. area, and a lot of those employees were getting reimbursed or giving money on a monthly basis because they wanted to keep down on traffic and they could commute to their job, and their employer was paying them to help pay commuter fees. Well, that's, as you can see, has been eliminated. Your employer can now reimburse you, but the employee, you can no longer claim that. So if the employer gives you that money, and then if the employer reimburses, you got to actually claim that on your taxes as extra income. All right, so that's that. Keep going. Number 7, casualty and theft losses. It used to be that you can incur insured losses because you might have you've heard a lot of natural disasters that's been going on lately in the weather with the whole global warming, if you believe it or not. Those fires, floods, earthquakes, and the disasters that were greater than 10% of your adjusted income, the loss could be claimed as a part of your itemized deductions and subtracting that loss. But now under the new law, deduction is allowed for property damage areas which are under a presidential declaration as a disaster area. So now you have to have that particular designation in order for you to be able to deduct that on your tax return. So it's no longer just because it was in a fire or just because your house happened to get flooded that you could deduct that. You have to have that presidential declaration. So pretty much, how do you know you had that declaration? You'll have to go on the IRS site, Google it to see if you have a presidential declaration for your particular area to be able to deduct that on your tax return for itemized deductions. Donation to college and receive tickets to sporting events. This is a big one. I go to a big school. I went to college at Ohio State, and this was a big deduction. A lot of people, I never did this, but I know a lot of some of my colleagues who are pretty good with donating to the college. This was a pretty big deduction back in the day, especially with college football tickets being anywhere from 100 to, on an average, $100 to $300 a ticket. If you donate to a college and receive tickets to an athletic event, because that's one of the way a lot of the big universities do that, and even the small ones, they do the same thing. You become a donor and you get access to receive tickets and things. We get one free pair of tickets and stuff like that. You used to be able to reduce that charitable ticket as part of your itemized deductions, but now that deduction is pretty much gone away. And a lot of people didn't even know about that, but that was something that was there, and now that's gone away with the new Tax Jobs Act. Now, I don't know how many people that's going to stop people from buying tickets to go to these games. I doubt it because, people are addicted to these sporting events, but it is what it is. That deduction that used to be there has disappeared. All right. Some of the other deductions that are very common, medical and dental expenses has been modified. I didn't say it deducted, and we use the word modified. If you plan to itemize in 2019, your unreimbursed medical and dental expenses will now have to exceed 10% of your 2019 adjusted gross income. In the past, that number was 7.5% of your adjusted gross income. And to be honest, most people, they never met that 7.5% threshold when it was 7.5%. So I don't see too many people still being able to meet the threshold when you get to 10%. If it was hard for most people to make that 7.5% threshold, I can really see it's going to be difficult for them to make that 10% threshold of their adjusted gross income. But it is what it is. State and local income, sales, and property taxes has been modified. This is a big one here because we have a lot of folks, depending on what state you live in, you still might have property taxes or sales taxes or income taxes. These things could be high, even in states that don't have state income taxes. Typically, those states that do not have state income taxes, they typically have high property taxes and sales taxes. Well, in the past, you were able to deduct that on your taxes. If you had maybe some big purchases and you paid sales tax on that, if you kept the receipt, depending on how large the purchase was, then you could deduct that on your taxes. Or they kind of gave you a scaled amount based on your household income. They would give you a set amount saying this is how much you probably paid in sales taxes, and then that's when they would give you that amount from a pretty much a calculation on your itemized deductions for you. Now, the property taxes part, that could be huge depending on where you at. As you see, it's been reduced. So the total deduction for the state please make sure you mute your phone, please. Please mute your phone. Thank you. Your total deduction for your state and local income, sales, and property tax is limited now to a combined total deduction of $10,000 and $5,000 if you're married filing separate. They don't.
So he's still talking.
All right, can you please, whoever's talking right now, can you please mute your phone? Please mute your phone. Thank you. All right. So right now your total deduction is to be $10,000. That's the most you can deduct for all the state, local income, and sales and property taxes. But if you're married filing separate, this is a way because some people might try to file married filing separate to try to see if they can get a larger deduction. The IRS now has reduced that to only $5,000. It will only be $5,000 you'll be able to do if you try to file married filing separate. So if anybody tries to calculate that to see if they get a larger deduction. All right. Now, as you see here, no deduction is allowed for real property taxes. So you used to be able to deduct the real property taxes if you had property overseas in other countries, but now that property taxes has disappeared. But if you have property taxes associated with carrying on a trade or business, they're still fully deductible. I put this in red because I want y'all to kind of, and there's some things I put out here. When you see in red, I want you to kind of do a little footnote, and pay attention to it as we get on down the presentation. We see here, as long as you had a business, a trade or business, it's still fully deductible. But if you do not have a business, then it's not deductible anymore for any foreign transactions or property that you might own overseas. All right, let's move on to the last few that we have left for most notable deductions for individuals and families, things that might have changed. We got the repeal of deduction for alimony payments. I do have quite a few clients that, we are 50% of America. The rate of divorce is 50% in the United States. So a lot of people that are out there that do or have had to pay alimony payments. As you can see here, alimony and separate maintenance payments are no longer deductible for any divorce or separation agreement that executed after the end of the last year, so December 31st, 2018, or for any divorce separation agreement that executed on or before December 31st, 2018 and has been modified after this date. So pretty much you used to be able to deduct your alimony that you paid for your spouse, and the other person that received the alimony had to report it as income on their taxes. That's no longer taking place. So pretty much the person who gets the alimony is getting free money. They don't have to report it on their taxes, and the person who had to pay it no longer gets that amount. So pretty much the person who pays alimony gets screwed, just to be honest. All right, so now student loans, the last thing, student loans discharged due to death or disability. This is very important because in the past, those of you who maybe had discharged your student loans, maybe because of a death, like I said, the person might have died, or that debt was able to get discharged, and maybe it got discharged, and it was income considered to that person's estate. Or for disability, a lot of you don't know, we do veteran disability claims. This is something you do not know. If you're a veteran and you have student loans, or you are a signer on student loans, or maybe you sign for your dependents on the student loans, if you get 100% total in disability, then you can get that student loan discharged. Well, in the past, that discharge even though you discharge, there's a possibility in the past that it would have been still included as income for any discharge, not the death and disability. Sorry, if you had discharged death for whatever reason, let's say you went through bankruptcy or some way you was able to get that student loan discharged, then that was still, even though it was discharged, you no longer pay that debt. The IRS considered that discharge amount as income. Well, with this new act, you're still going to have, if you didn't get a discharge because of a death or a disability, you now you're going to have to pay income on it. But folks here who have discharged because of death or disabilities, they made it very clear that you do not have to consider that discharge amount as income. So this is a little plug for the VA disability benefits. If you have VA disability benefits or don't, and you want to get your increase there, you definitely want to talk with us about that if you have student loans, because that could be a huge payoff. I'll give you an example. We had a client who had $80,000 in student loans that he was a signer on for himself and one of his children. And after he got his 100% total in disability, he was able to get his student loans discharged in probably about 30 days after he got his 100% rating. So that's a huge obligation that's wiped away from that 100% disability. So you definitely want to look into that. All right, next thing, federal tax withholdings. Let's go on, move on. Federal tax withholdings may need adjustments. So with that increase in standard deduction, or maybe you're not going to be able to deduct the things you thought you used to be able to deduct, you definitely want to make sure that you adjust your W-4. Your W-4 is that form most people typically only see one time if they go to their new employer, and then from that point, they fill out that form trying to figure out how much money do I put on my withholdings. And you might have heard when you went to the HR department of that office, to say, well, how many children do you have? How many people in your household? It's me and my spouse, and then I got 2 children, so put 4, which is typically wrong, but that's typically how people tell you to fill it out. Well, you might want to go and get yours adjusted, especially if you haven't done that in the last several years, especially with the tax law changes that came about. One of the places you can go and visit, you can go to the G&G Associates website, and we have, and I'm going to show you a little bit about the website here. You can go to our website, click on the Taxes tab, go to Tax Consultant Forms, and then you can go right under the IRS Tax Forms Publications. You can go here and you get to the W-4 right there. So you click on the W-4 form, or you can go to the IRS website and you can click on the tax withholding calculator. So on the W-4 form, those you're not familiar, if you remember this form when you first went to your employer, this is the one that you might want to adjust. And as you can see, this is something, as you see right here, the purpose, I always like to point this out to my clients, complete this form W-4 so your employer can withhold the correct federal income tax from your pay. Consider completing a new form W-4 each year, keyword, each year, and when your personal or financial situation changes. So if your children left your home because they went on and went to college, got divorced, got married, had another child, income increase, decrease, one spouse started working, those are big income changes. Those are things that you want to make sure you go and you make adjustments to your W-4. As you can see, it should be at least considered as part of your new tax year planning to see if you need to make adjustments. Got increase in pay, a huge increase in pay. These are some of the things that you might want to definitely consider doing with the W-4. If the form is pretty self-explanatory, it tells you how to fill it out, But if you want a calculator and try to make it a little easier for yourself, you can click on and you can go right to the IRS's website, the IRS withholding calculator. This withholding calculator has tips. You click on that withholding calculator right here. It'll take you right there to the calculator, and then you can start is answering the questions, and the IRS will kind of give you an idea. You sit down and go through, I'm single, I'm married, filing separate, and then that'll help you to determine which situation you need to do to help determine should you be 1, 2, 3, 4, or 5 on that employer's W-4 when you fill it in to give it to your employer. All right? Now, before that, I want to make sure you understand why this is important as well. Can you all still hear me? Can you all hear me?
Yeah. Yeah.
Yes. I just want to make sure somebody texted me that the audio went out, so I wanted to make sure it wasn't my end. It might have been their end. All right. Good deal. All right. So, people, I wanted you to understand as well why this is important as well. I've been doing taxes for 18 years, and it always fathoms me when I see clients that get the 10 and the 12 and the $15,000 tax refunds. I want you to understand what a refund is. It's very important. A refund is just like that. You paid the IRS too much money, and they're refunding you the overture that you paid. To me, just my form of thinking, I can use my money a lot more than what the IRS could do with my money. As we already see what the federal government is doing now, they're playing games with your money, especially you all who are furloughed. I'm sure you can use the money even if you're not furloughed. You would rather keep that money in your home than let the IRS hold on to it, and then you get it at the end of the year, at the beginning of the next year, because you're not going to get it at the end of the year. But if you adjust your W-4 withholdings and you adjust it correctly, you have very little money that's taken out of your you adjusted correctly, you have all the money you need, and you have very little that should come back on a tax refund. My goal is to make sure I don't owe nothing and don't have a big refund. If I keep myself within $1,000, if I was to do that, well, I'm not in that tax bracket no more. I pretty much pay all the time now. But when I was an employee and I was working, if I was to get no more than $1,000, I felt I did great. But if I got more than $1,000, I was adjusting my W-4. I wanted to make sure I didn't get more than $1,000 refund because I could use that money. Think about it. If you're getting back 3, 4, 5, 6, whatever amount of money, take that divided by 12, and that's if you're getting $4,000, that's almost $400 a month that could come into your household. I guarantee you that could pay, if not one bill, but several bills, a house, electric bill, cable bill, car note, whatever, instead of you giving it to the IRS. I always like to use this analogy. If you went to the gas station and you put $20 worth of gas in your car and you gave the attendant $50, would you tell them to hold the other $20 and I'll come back next week when I get gas again? No. So why do you do that with the IRS? It makes no sense. So adjust your withholdings the way it should be. Don't let them hold any more money than they need to of yours. Get all your money now. Use it. Pay off debt if you got debt. Or if you don't have any debt, use it to invest. Because when you're giving them the interest-free loan, that's what you're doing with the IRS, giving the IRS an interest-free loan. You could have been using that money to invest in your own business. All right, so think about that. All right, now, military severance tax refund. This is one of the big things that came from the Tax Cut and Jobs Act for those of us who were in the military. Now, one of the things that came with that and what this military severance pay, because some military folks, when they got out the military, some were put out because they might have had a disability, or they might have received a severance pay, and when they got out for the disability, unplanned, or because of an injury, they had received maybe a severance pay. Or if a military person got out the military and, for instance, they got a bonus because they took it early out, or they didn't rank the rank, they would give them pretty much like a severance package. That's what they call it. They give them some bonus money and then leave out when they got out the military. Well, the Tax Cut and Jobs Act pretty much what that law pretty much did was it waived the 3-year amended return statute. Well, because of that severance pay, a person who got out because of a disability falls under the same statute as you see here of somebody who received basically a personal injury or some type of settlement from a lawsuit. So pretty much if a person got out the military because of a disability, they injured themselves and they got a severance pay, that money was not supposed to be taxed. Unfortunately, for about the last 30 years, veterans have been unlawfully taxed. And I've been helping veterans get this money back for several years now. But one of the hiccups I used to run into is, depending on how long ago that veteran got out, it fell under that 3-year amended tax rules. Because remember, the IRS says basically if you want to amend your taxes and get that money back, you had to do it within 3 years from the date of that tax return. Well, with me being able to, that was one of the issues, because I might have a client that had gotten out maybe 5, 6, 7 years ago, and I wasn't able to go and get them their money back because they fell outside of that window. But with the Tax Cut and Jobs Act in 2018, the IRS has waived this 3-year amendment rule. So I can go back to the 1990s. I can go back to the 1990s and help veterans get their money back from the IRS if they were unlawfully taxed for their disability severance pay when they got out the military. So if anybody falls into that category, knows someone that falls in that category, they got a severance pay, please have them contact us, because I've helped quite a few veterans, and the largest deduction I've gotten back for someone, a tax refund, was over $35,000. I got $45,000 to help the taxpayer get back in a refund, because that taxpayer got almost over $100,000 in severance pay. So that's huge tax deduction there for a person. Now, that becomes very important because, as you can see here, I have a flyer. I've been helping veterans get this for a while. I have a flyer here because the IRS, that taxpayer might have received a notice from the IRS in the mail. And you got to think about this. Right now, as you can see, the IRS has made it kind of like a catch-all. If you can't find your documents, if you just want to go in and get if you just tell them you got a severance pay and you fell in that category, you can show anywhere, any document saying you was taxed. If you got out the military between 1991 and 2005, they're just going to give you a flat $1,750. If you got out the military in 2006 or 2010 and received this disability severance pay, they'll give you $2,400. And if you get tax years 2011, 2016, that's $3,200. Look at the example I just gave you earlier. The taxpayer, I told you I got her back $40,000+. She got out in around 2014, all right? And when I got her that several years ago. Well, if she'd have taken this catch-all, $3,200, think about how much money she would have lost. I got her back over $40,000. So that's where understanding somebody who knows what they're doing, a tax consultant versus somebody that's a taxpayer, you try to fill this out yourself by just sending in these documents the IRS requests, you could be shortchanging yourself if you don't know what you're doing. So make sure you get with somebody that knows what they're doing. If you apply for this, or you know somebody who may fall in this category, to make sure they get all the money that's allotted to them. All right. Now, let's move on to businesses. Tax changes for businesses. We talked just previously about those for individuals and families. Now, let's move along to the businesses. Hopefully now you kind of see, or maybe starting to see, that a lot of things went away for people who were itemized deductions. I always used to say most people only had about 7 to 10 legitimate deductions they could take outside if they didn't have a business. And the IRS has now pretty much even knocked that down to really only about maybe 3 to 4, I'd say about 3 to 5 deductions you can take if you don't have a business. Well, the Tax Cut and Jobs Act has changed deductions and depreciation expenses. One of the big things they've done for businesses is they've changed the deductions, depreciation expense, and tax credits for people who have businesses. In a nutshell, let's sit back and think. The people who are making the rules and the laws, that Congress, House of Representatives, President, all those folks, they're making these rules. One thing they all pretty much have in common: they all have businesses. Majority of them aren't poor. Majority of them are pretty wealthy. And they're not there for the money, even though, unfortunately, it makes no sense to me that they're sitting there and still getting paid while other government workers aren't. It's just, you think about it. Why are they there? Most people they say they're doing it for the people. Well, they don't do that because they make decisions totally against what their constituents tell them to do. They're in there because they want to affect change that best benefits themselves. So knowing that majority, I forgot the number, but I know it was in the high 80s. The last time I did this, it was several years ago when I read a statistic. It was in the high 80s of those who were in politics that have businesses. They were in the high 80%. Majority of them have businesses, and that's the reason why they're there. They might say other, but you just think common sense here. All right, and this is what happened with this Tax Reform Act. It has made owning a business that much more lucrative. You've heard it. They've said it before. The tax cuts and everything benefited the wealthy and the rich. And fortunately, or unfortunately, depending on what side of the curve you're on, 10% of the wealth in America is owned. I'm sorry, 90% of the wealth in America is owned by 10% of the people. And those 10% of those people, majority of them have businesses. So these changes are really affecting them more. You might think you're getting a bigger refund, but really not. It's helping those folks that are already in the upper echelon be able to save even more money in their pockets, and it's going to affect in other ways later on down the line. If you want more, I'm going to give you some insight. If you want to really know more about the tax reform updates, you can go to irs.gov, click on tax reform / tax reform. And you can find more information about the business and tax, and you can read in more detail. I'm trying to go over just some highlights here. Of course, I don't want to keep everyone too long and go in the weeds, and plus I don't want to put you or myself to sleep. But if you want to go read and you want to get some very good material to help you go to sleep at night, definitely go and read the tax reform provisions that affect the business and of course, the family and personal side as well. The same is on that information's on the IRS website also. But even though it might be boring or dry, it's needed. All right, this is your home. This is your business. You definitely want to make sure you are able to keep all that you are legally able to keep. One of the big things, again, I said deductions, depreciating expenses. I wanted to give you some of the regulations or some areas that you can go do some research. Changes to deductions, depreciating expenses may affect taxpayer. If you want to know more about the business expenses, it's Publication 535. If you want a good place you can go to IRS, put in Publication 535, or you can visit our website, G&G Associates website, tax forms, and I have Publication 535 just in case you can't remember. So if you go to taxes, IRS tax forms and publications, click on Publication 535. That's pretty much the one you really want to know about things that you can deduct in your business. All right? So that's a good place. You can go and visit that. Publication 946 will kind of go over the depreciation part, which is one of the other big deductions that are going to be coming out for those who have businesses. So let's go over I wanted to break down some of the big changes for those of you who have businesses, and I know a lot of folks who are on this call have businesses, or maybe you don't realize you have a business. Let me tell you this. This is how you know you have a business or not. And I have it all the time with my tax clients. A lot of people don't realize they have a business. If you get a W-2, you are an employee. If you get a 1099, you are an employer. Yes, you are an employer. Somebody's paying you as a contractor. You have your own business, whether you realize it or not. And the IRS is going to treat you like an employer, whether you realize it or not. Now, if you don't realize you have a business and you count that income as an employee, which you can, you definitely hurt yourself. You definitely give an IRS more money than you need to. All right, so definitely understand the difference between being an employee and an employer. All right, so one of the big things that came out of this is kind of this new deduction right here, what they call the new deduction for qualified businesses income of pass-through entities. First of all, what is a pass-through entity? A pass-through entity is one of those entities where you have a business and you count your income, you reduce your income through your expenses, and anything left pass through to your personal taxes. All right? So for a good example, let's say you made $100,000 in your part-time business. All right, let's be more realistic. You made $10,000 in your part-time business. All right? And you had expenses of $5,000 that wiped away that income from the $10,000. You have a profit of $5,000. So that $5,000 comes over, it passes through to your 1040, and now that 1040, that extra $5,000 gets added to whatever other employee wages you might have. But vice versa happens as well. Let's say you only made $5,000 in your part-time business, but you had $10,000 of business expenses, especially in the earlier phases of your business. Most people have more expenses than they do income because you got the startup costs, you're learning your business, things of that nature. So as did the income pass through, the losses pass through. So the losses of that $5,000 would pass through to your personal tax return, the 1040. So if you made, for instance, $50,000 on your regular job and you have $5,000 of losses from your business, it passes through to that personal tax return, and your taxable debt for easy calculations would be $45,000. That would be your taxable income. All right. So hopefully that made sense and what I mean by pass-through entities. But what benefit does that do for you now with the new tax law by having a business? What the IRS has done now is those people who have businesses, they're allowing you to deduct 20% of your qualified business income as a deduction. So you can get 20% deductions from that income. So you'll get a credit, or not a credit, you'll get a deduction from that income because you have a business. It's like they want you to get a business with this tax law. That's what I'm trying to get you to see as I do this presentation. Get a business. That tax law is going to benefit those who have businesses. Those who do not are not going to take advantage of the changes that came from the new tax law from 2018 and on. All right? One of the big things that's going to change, and it's going to be a whopper to, I already know to some of my clients, because this was a big deduction a lot of folks used to take, is there going to be a limit on deduction for meals and entertainment expenses. In the past, you used to be able to deduct 50% of all your entertainment expenses directly related to the activity or conduct of the trade of your business, or incurred immediately, and those expenses occur immediately before or after your substantial bona fide business discussion. All right? What does that mean? So in the past, let's say, for instance, I had a business meeting with a colleague. We went out. We just came to the office or whatever. We had business. We talked about what we were going to do. Then later on that night, we're done. We said, hey, let's go out to a sporting event. Let's go out to a basketball game, wherever city we're at. We met. Let's go to a basketball game. Went to a basketball game, bought tickets, had lunch, dinner, drinks, and all the other stuff. I used to be able to deduct that expense because that entertainment, as long as it was within 24 hours prior to or after, that's what you get here immediately before or after, I was able to legally deduct that entertainment. We didn't have to talk about any business while we were at the basketball game, drinking, eating, whatever, but we had to have talked business 24 hours prior to or after. That was a huge deduction. People were taking thousands upon thousands of deductions that way, doing things. Well, IRS caught up with that, and they saw a lot of folks were taking this expense, whether it was lawful or not, whether they were talking business or not, because there really was no way for them to really figure out if you were or weren't. Now, you were supposed to do record keeping to keep track of that expense, but I can tell you most people didn't, because most of you didn't realize those rules. But you can see now the IRS has eliminated it. It's totally eliminated the entertainment expense. There's no longer an entertainment expense that you can deduct. Now, you still can deduct 50% of the cost of meals if you went out, take your employees out if you're an employer, or you had a potential client, business customer, and you took them out to eat, to talk business. You can still deduct that meal, but not that entertainment event later on. All right, so that's a huge difference there. So you basically got that active or that meal, you have to actually have talked business now to be able to deduct that, because before in the past, you didn't have to talk business at that meal. Now, in order for you to deduct it, you will have to conduct business at that particular time in order to deduct that meal. And we'll talk a little bit later about record keeping, which is one of the many mistakes and why most businesses fail, because they don't keep good records. All right, now, the next thing, new limits on deductions for business interest expenses. In the past, you used to be able to deduct the interest from your business as long as it wasn't more than 50% of your adjustable taxable income. That's the key. Adjustable taxable income. You used to be able to deduct that. But now the IRS has changed those limits of business interest and encouraged certain businesses, generally businesses with $25 million or less in average annual gross receipts, which I'm pretty majority of folks I know on this phone call, probably myself, everyone else, not making $25 million. I tell you, if I'm making $25 million or more in my business, I'm probably not on this call, but $25 million or less in average annual gross receipts, your business interest expense is limited to the business interest income plus 30% of the business adjusted taxable income and a floor plan financing interest. Don't try to wrap your head around too much of that, but if you want to study it, you want to get more about it, trust me, you can go on the IRS website and learn more about that. Pretty much just say the limits have reduced, okay? Just think of it that way. Your limits have reduced on things that you could reduce as far as your business interest. All right? Now, next thing, depreciation. All right, so let's look at the depreciation. This is a big one. This is a huge one that's come back and people have used back in the past that kind of went away and now it's back again. Temporary 100% expenses for certain business assets. This is huge. This is one of the strategies that the wealthy use. They use buying assets or buildings or equipment or things that can offset their income. So this is one of the huge things that you're able to do. 100% allowance generally it decreases by 20% per taxable year, but you're able to expense 100% of that business property now. So let's say you had a business and let's say you had a machine operating business and you needed a new machine and you might have business income of, let's say $100,000, but you would like to have had a new machine. Back in the past, let's say you bought a new $25,000 equipment to help with improvement or increase your product supply output or whatever. You used to have to expense that deduction maybe over 5, 7, 10 years, depending on what that particular depreciated item is. Where you're able to take now, you're able to expense 100% of that. So if you had income that year of $100,000 and that new machine was $25,000, you just reduced that taxable income by $25,000. But in the past, you might have had to expense that over a 5, 7, 10-year period. So that $25,000 machine, if it's, say, for instance, was a over 5-year period, you only be able to take, pretty much like $5,000 of that $25,000 expense in that one taxable year. So that could be huge depending on what tax bracket you're in. Remember, I told you the tax brackets, especially if it's a pass-through entity, could be as low as 10 and as high as 37%. So depending on what tax bracket that is, that could be a huge deduction for you. So it can help offset any deductions that you may have. Same thing here. I'm not going to try to explain to you what the difference between 179 property, things of that nature, but that's just another income to tell you those deductions for these expenses have increased. As you can see, it went from $500,000 to a phase out of $2 million in 2017 to now $1 million, increased phase out to $2.5 million. So this is where you probably heard people who are buying airplanes and things of that nature to offset their income. This is because they can use that now to offset that income by purchasing those type of items, whether they take that whole expense if the airplane is less than $2.5 million, or they could take that whole expense that year to offset that income, or again, they could still streamline, deduct it over a certain period of time for whatever that depreciation expense is, if it's 5 years for a particular, like airplanes, 5 years or 7 years for some other properties out there. All right. Last thing, luxury items. You probably heard people who bought the Hummer. There was a Hummer phase back about 10 years ago where everybody was buying Hummers. I had probably about 5 tax clients who bought Hummers because they had the weight limit. If you ever had a truck that was over a certain weight class, you could 100% depreciate that item. And it was using the same strategies folks were doing up here. They were buying luxury items, not just Hummers, but even luxury cars. But now that kind of went away. The depreciation, they weren't able to get that whole expense in 2017. But now the IRS has brought that back, those appreciation limits for these types of passenger cars. So these luxury items are now going to be able to be used again, and the income limits for these type luxury vehicles have increased with the new tax law. So again, tell me, the person that has the luxury vehicle has a job, you just paying more money in interest. If you didn't pay cash for that luxury vehicle, you're paying the bank more money and you're getting nothing out of it. But at least if you have a business, you get something out of it. That's why people who know me personally, they know I do not have new cars. I do not buy new cars. Don't want a new car. It's a waste of money to me. Because the car can't make me money, I don't want it because I don't want to pay the bank anything. So for me, I drive around in my car. I still have my 91 Honda Accord. If you all on my Facebook page or know me, I just shipped my 1991 Honda Accord down to Florida for, as you know, those you don't know, we often offices in Florida as well. So that's going to be my driving car when I'm down in Florida. It drives. There's absolutely nothing wrong with it. So why do I need a new car? If I need a new car, I'll go and get one from Enterprise, Hertz, and I'll get it for the weekend or the weekday or the week I need it, and I'll turn it in at the end of my rental period from when I'm done. But that's one of the benefits of people who have a business. If you have a luxury car you want to deduct it, then it makes sense. If that luxury vehicle makes you or saves you money, then that's when it makes sense. But if that luxury vehicle definitely doesn't make you or save you money, what's the purpose? All right. At least that's my form of thinking. All right. Next thing, fringe benefits. It does apply, and most of the benefits I have here, like I say, all of the things I'm having on these, I'm having on this conference call, this really applies. I have clients at every one of these expenses, and it's more some of the other things that's out here, but the limitations are out there. Most folks that I know or have my tax clients don't really apply to them, but I'm picking out those things that really apply to some of the clients that I have. This is one I have right here. We're talking about the suspension of the exclusion for qualified bicycle commuting reimbursements. Yes, I have clients who would take deductions for their bicycles. Why? Because I have a lot of clients in the D.C. area. If you think about it, most large cities now, think about it, they have the bike lane. I was on NPR. I don't know if any of you listen to NPR. NPR, I was listening, I live here in the Hampton Roads area right now. Norfolk, Virginia, if you know anything about Norfolk, this Hampton Roads area, it seems like they put a bike lane every time I go to Norfolk. It seems like a new bike lane on a new street every time I go. Well, I was listening to NPR probably about maybe 8 months ago, 8 months to a year now, and they had I guess the city developer or planner or whomever it was that was on as a guest speaker that day. And he was talking about how they were creating these bike lanes because to reduce traffic, a lot of these cities are putting in these bike lanes to encourage businesses to come in some of these urban development areas where now mostly the abandoned buildings where the industries can come into these areas. And of course, when you have all these industries and a lot of workers working in these city areas, you cause a lot of traffic. So to offset that, especially if the city doesn't have mass public transportation, they're developing these bike lanes so that the bike lanes people can ride their bikes to work from their homes. So all these urban cities, as you see, the cities going up, they're redeveloping these homes because they're getting closer now to the industries because the industries are coming back into the cities where the jobs are going to be created. But now to reduce that traffic, they're creating these bike lanes so that folks can drive to work. Where there used to be a deduction, all that to say, there used to be a deduction there, $20 per month for employer reimbursement for the bicycle commuting expense. Where now in 2018, the reimbursement is a business expense. Employers must now include, before you got the deduction, you didn't have to include it as income, but now as you had to include 100% of this expense on the employee's wages. So your employer might have encouraged you to ride that bike. You got the income from the employer. It wasn't considered income, but now it's going to be considered income. Just like that parking expense or the commuter expense earlier when I talked about the personal tax return. Well, this one is kind of the same thing here with the bicycle. You didn't have to report that income that your employer may give you to encourage you to ride your bike to work. Now, if you do that, it's going to be considered income. Still, that $20 a month might be worth it to avoid having to sit in traffic or anything else, or especially if you're in a warm area. Of course, it doesn't help if you're in an area that's cold at the moment, especially with snow and rain and everything that's going on. But in the nice spring and summer months, it might be worthwhile and fun to ride your bike to work and get paid that expense. It might be worth it to save yourself time as well and the hassle of getting stuck in traffic. All right, and the last fringe benefit is suspension of the exclusion qualified moving expense reimbursement. I talked earlier about the moving expense. This is one of the fringe benefits for businesses. The employee, remember, you no longer get to deduct it, and if you get paid that from your employer, it's going to be income considered on your W-2. But the benefit, of course, if you have the business, because we're talking about the business side of this, you're able to deduct this now as the business owner. You still get to deduct this expense for your business for paying for the employees' moving expenses. Of course, generally members excluded of those of the military active duty armed forces. They are excluded from being counted as income on their wages. That exclusion applies to them. All right. And see here, economic development. This is a big one. I have a lot of clients that do a lot of real estate investment. Myself, I do real estate investment, and I'm actually looking in these certain areas as well, especially because of the credits that come with this. You've seen it. It's part of the sociological cycle. Probably the best class I ever took when I went to college, the best elective I ever took outside of my golf. That was the best thing that helped my golf game by about 12 strokes by taking golf 1 and 2 at Ohio State. But economic development, sociology was was a favorite class of mine. This is one of the things that sociology class talked about was the changes when you talk about the revitalization of historical areas, and you see it city by city. They're starting to revitalize them. Like I said, they're bringing the bike lanes in, taking the old buildings, restoring them, redoing them. And the reason why a lot of these are happening in cities is because the developers who smart, who know the rules, who know the tax laws, they're able to get credits from the city. They're able to get rehabilitation things. They're able to get tax breaks. That's what you're able to get here. And these are some of the changes that come along with that, the rehabilitation tax credit, the opportunity zone credit. So look in your area if you really want to know how to maybe take your money and want to know how to benefit from areas like this. Think about these zones in your city, because every city has an opportunity zone. Every city has one of these areas, a rehabilitation zone and an opportunity zone. You just have to go look, find it, go on a city planner's website, go down to the city hall office and look for that, and you can find these types of areas where you could probably get real estate, move in yourself. This is one of the things strategy I used to do back in the day when I was in active duty military and I was moving. It seemed like every year I would go and buy a home, move into an area, move in, almost no money down because it was a personal resident, fix it up, move out, turn it to a rental property and get breaks and credits and do from there. But this is great strategy, great opportunity for those who want some tax breaks, that you can do this and learn how to do that and take advantage of those opportunities out there. All right. So, as I mentioned earlier, and I want to talk about job versus business. Hopefully, from what you just heard from me, you've seen, or maybe now it came into your mind to understand the difference between having a job and versus having a business. The Tax Cuts and Jobs Act, short TCJA, you'll see that a lot in a lot of articles out there, especially now as tax season starts to come. It clearly favors those with businesses. All right, if you haven't seen it, why you need a business, or think you maybe need to start a business, definitely really consider that from after listening to today's call. All right. I've talked earlier about the difference between 1099 versus W-2. 1099, you are an owner, a business owner. I get a lot of folks, for instance, I probably got maybe 10 clients that either, well, at least last year, who drove for Uber or Lyft. And I'm sure I'm going to get even more of that now, especially with clients who, I got a lot of government employees that are my tax clients, and probably those who've been furloughed over the last 30 days now are probably doing Uber or Lyft. I guarantee you. And that's the 1099 that you get from Uber and Lyft. They're going to send you a 1099 if you make over a certain amount of money. And so you have a business. You do not have a job. You have a business if you receive 1099 income. So you have access to business expenses that you maybe do not realize. All right, if you receive W-2, remember, you're an employee. You basically get the 3 to 5 deductions that I told you about earlier now, since most of the other ones got wiped away. You basically got about 3 to 5 deductions that you allotted to you if you're an employee. If you are an employer with 1099 wages, you have access to almost over 475 tax deductions for businesses and self-employed individuals. Common sense math tells me if I have income and I got 5 deductions if I'm an employee, I don't have many opportunities to reduce my taxable income. But if I'm an employer and I have over 475 tax deductions, then that tells me I just need to learn all the tax deductions that are allotted to me. If I learn those, then I have access to be able to reduce my taxable income by 475 different ways. Not that all 475 are going to apply to you, but I guarantee you got more than 5, 3 to 5 is you're going to get if you're an employee. Some of the most common ones, most of you don't realize, your cell phone. All of you right now are dialing in somehow to this call. I don't know if you're on your cell phone, your internet phone, your DSL, your landline, whatever way you calling in right now. If you had a business, guess what this is? This is educational training. This is professional education you're getting right now. So if you're on one of those means of listening to this webinar, if you're on the internet looking at this webinar, your internet expense is partially tax deductible because you're using that system to enhance your educational knowledge. If you're looking in from your cell phone, those you got the big cell phone or iPads, that's partially tax deductible. So many more 475 deductions out there allowed to you. I got the different publications here. Again, you can go to my website, get access to that, or you can go to our website, irs.gov.us, You can go there, put in publication 535 in the search menu, and it'll take you right to the IRS website where you can pull down business expenses. Matter of fact, let's go there and just see the brochure right quick. I just want you to be able to see that. It's not that bad. It's not even that long. Most people get intimidated because they go on and look at one of the IRS publications. But look, this publication is only 54 pages long. And I can tell you the first 7 pages, first 6 or 7 pages is nothing but, not anything that's really cumbersome. But I would definitely suggest that you read every one of these publications. This is the first thing I did when I started my business back in 2003. I read every publication I could get my hands on. Publication 535, you can see here publication 463, 334. I read all the publications. But the great thing about if you read these publications is that, as you can see here, once you read it one time, you don't have to read the whole thing every year. You got one page of what's new. So if I go to page 2 of this publication, if I read it, say, 10 years ago, and I want to see what changed in this publication, all you got to do, you see, this just tells you what's new right here. Not much change. The only thing that changed in this publication was the standard mileage for vehicles. That's the only thing that changed. So you don't have to read it every year, all 54 pages. So I recommend, and this is what I did when I first started reading it, I read my books, I highlighted it, put tabs in it, and then from that point, every year I would go to the IRS publication, see what's new for 2017, as this was 2017, what's new for 2018, and that's what you do to figure out what's new for that particular publication for that particular year. All right? And that applies to all the publications here. Publications for travel, entertainment, and gift expenses. We talked about car expenses. That was earlier. And IRS publication 334, tax guide for small businesses. Anything you want to know about small businesses is in that tax guide. And do know, all these publications are free. They're online, or if you are a hard copy guy, you don't want to waste your ink or your toner or print paper, you can call the IRS toll-free number and just say, I would like to request to get a copy of the publication. Sometimes you can go to your local IRS office, but they're furloughed right now, some of them. Some of them said that they've been told to come back to work, but I do know personally all of them did not. And I've seen reports that all of them say they're not coming back, just like some of the TSA folks. They're playing sick or don't want to come back and not get paid, which I do not blame them. But you can call them, go to the local office, whenever they get off furlough, it might be there now, still be able to get it. Or, again, you can go right online and pull it down and print it off, if you can go print it off, and you can get it for free. It's costing you not one dime. Now, I do have some private places here that I recommend to my clients. All my clients, especially if you just started a business and you didn't know you had a business and you've been on this call and realized I have a business, in addition to reading these, I definitely suggest you get these books here, and you can get both of these books right on Amazon.com. Neither book costs more than $20. Neither one. And it's tax deductible if you have a business. So 475 tax deductions for businesses and self-employed individuals. I like it because it breaks it down really easy to read, alphabetical order for you to find out all the deductions that are allotted to you if you have a business. Lower your taxes big time. One of the first books I ever read when I started a business outside IRS publications. This guy was a former lawyer and worked for the IRS, former auditor for the IRS. He's very good public speaker. He has live seminars if you want to go see him live. Got video online on his website. Great book, audio things is there for you. He always keeps up with the tax laws, tax rules. Very easy to read and learn. I suggest if you really want to know how to take advantage of your business, read all these publications right here. All the first 3, again, are free. The last 2 tops, $40 total for the last 2 books. And if you don't want to spend $40 to invest in your business, you're really not trying to have a profitable business, I'm looking at it, especially when that $40 is tax deductible to your business. Now, as you see, I got guaranteed 10 to 35% rate of return on your investment. What does that mean? If you invest in you, you have a guaranteed 10% rate of return. I used to ask questions when I used to do seminars. I used to do tax seminars like I'm doing right now. I used to do it in live. Of course, this was before technology, the Wi-Fi, all this, go to join.me. We didn't have this back when I was doing live webinars 12, 15 years ago, I used to go city to city and do live tax webinars for networking companies. They would fly me in to come and do tax training. And so one of the advantages, or one of the questions I used to always ask was how many people here would be happy if they were to get 5% rate of return on investment? You'd be amazed at how many people would raise their hand, happy to get 5% return on investment. Then I would say, how many people would be happy to get 10% rate of return? More hands come up. Oh, yeah. Then I go and say 15%. And they'd be like, absolutely, but you ain't going to get 15% rate of return on your investment. And I just shake my head. I was like, okay. How many people would love to get 35%? I said you can get a guaranteed 25% investment rate of return investment on your rate, 25% guaranteed rate of return on your investment. And I'm talking, of course, those folks who are in the 25% tax bracket. Why? Because as you see here, if you remember our tax bracket on the first slide we talked about, the IRS tax bracket goes from 10% to 37%. I had 35. It should have been 37 right here. But it goes from 10% to 37% tax return. That's your tax bracket, right? Well, if you had a business, as I said earlier, and you had income and you had deductions, even if you had a gross profit and you were able to reduce your taxable obligation by $10,000, whether you had a profit or a loss, and you were in, let's say, the 25% tax bracket, that means you saved 25% of that $10,000. That's $2,500. 25% guaranteed return on your investment. But what's the investment? You. You invested in you. You're not investing in somebody else's business. You invested in you. I'll take 25% of return in my own investment any day than in somebody else's. And so once you learn and you go and read these books like this, and then you go and continue your education and learn how to increase your trade or what you're doing in your business, how to invest your business, how to expand your business, how to invest in your business, then you can guarantee yourself 10, 12, 15, 22, 25, 35, 20, 37% return on your investment. And this is just federal, folks. I didn't even add in the state. So the same thing applies. If you had state tax of 3%, 5%, some state tax, like those folks who live in New York, 10%, 15%. You also just add that to your federal tax bracket. That's what you're saving, and that's what your guaranteed rate of return, if you can deduct that stuff from out of your business. All right? So understand that. Having a business, by far, you can guarantee yourself a rate of return when you invest in you. How do I know you're investing in you? Everybody on this call, I know you're investing in you, because I already know some people that wanted to be on this call, they couldn't be on this call because it's a football game that's probably on right now. Because that football game was more important than them being on investing in their own business. All right? So, but guess what? They're investing in somebody else's business. When they're watching that TV show or they're at the game and they're giving their money away to the business owner that's getting the income and their money, thank you. You're helping their business out very well, but you're not helping your own. So understand and realize when you get off your job, whether it's a 10-hour job, 8-hour job. When I started my business in 2003, I was working 10-hour days, 10, 12-hour days. And I got off work, I worked 6, 7 hours after I got off work. Didn't watch much TV, but because I wanted to invest in my business. On weekends, it's funny, I sent out a text today to somebody to remind folks about the call. They was like, man, you up at 5:40 in the morning on a Sunday? I'm self-employed. Heck yeah. I get up 5:40 in the morning when I used to go to work. I had to be to work 5 o'clock in the morning sometimes when I had a job. Why I'm not going to get up at 5 o'clock in the morning with my business? There's a lot of you on this call right now, probably on weekends. You don't want to get up past 8, 9 o'clock. You don't want to get up before that. But you get up every morning at 5 or 6 o'clock in the morning to go to your job. Well, on the weekends is when you're supposed to be investing in your business. You should get up at the same time on the weekend to invest in your business, because it's you. Nobody's going to get you a guaranteed rate of return but yourself. Because when you invest in your employer's 401k, and I know because I see investment accounts all the time, because I told you I'm a tax and financial consultant. Because when you see your taxes, I know the rate of return on the taxes. If I see your income statement that come in from your 1099 interest or your 1099 DIV or your investment portfolio that your financial advisor sends to you, I know your rate of return right away. Most people do not, and this is statistically, you can look online, the average person gets 3% rate of return on their investments. Go Google it. 3% is the average what a person gets on their rate of return for their investments through a 401k, at their employer, and things of that nature. But I just told you how to get 10 to 35%. So if you gave $10,000 into your 401k, for instance, and your employer, you made 3% if you were lucky, that means you only made $3,000. I'm sorry, you only made $300. My fault. Easy, not bad math. So if you got 3% return on your money, you only made $300. But I just told you if you got 10%, which is the lowest tax bracket, and trust me, if a person invests in $10,000 in their business, they're not in the 10% tax bracket unless they have a business. Understand that. You could make actually $100,000 in your business and be in a 10% tax bracket. What? Absolutely. But if you make a $100,000 employee, you're probably in the 25% tax bracket. Because a person with a business probably offsetting that with these 475 tax deductions, and they're in a 10% tax bracket. Right? So if they were able to offset that 100,000, they normally would have been in 25% tax bracket, but now they're only paying 10%. They just got a guaranteed rate of return of 15%. See that, man? That's understanding. That's how wealthy people become. That's how wealthy people stay wealthy, and how people on a job who think they're wealthy or think they're rich aren't really, because they don't have anything. Because once that job stops, some of you may know people right now who furloughed. I got clients who tell me I can't go on for like the VA claims. I can't do anything right now because I'm furloughed. I got to take a break. I can't do anything. You know, there's a lot of people out here who probably going to be scared of not being able to pay bills. First of the month is right around the corner in February. How many people are not going to be able to pay bills? How many people don't have a backup plan? You want to have a plan A and a plan B and a plan C. All right, always. Because that's an old saying, those who fail to plan have planned to fail. So remember, the best time for you to start your business is right now when you have a job, if you have a job right now. While you have guaranteed income, while you have sources to take care of yourself, that's the perfect time to start your business. And we say, what type of business? Whatever you like, whatever suits your fancy. You know, my thing is I always try to find a business that I knew was a need. That's why I started doing taxes. One thing, 3 guarantees in life. You're going to get old, you're going to die, and you're going to pay taxes. So that's why I always started, let me learn about taxes. First, I was trying to learn about how to save taxes, and so I might as well make this a business, must educate myself very well. And I've been doing taxes now for 18 years, guaranteed income every single year. So that's just the benefit. So start a business, of course, doing something you like to do. And whatever it is, that could take you to the next level. Mind your business, and if you mind your business, then you would change your outcome for you and your family, your next generation. Trust me, your next generation learns from what you do. So if you can show them and expand on them, they might not make the same mistakes as the prior generation did and got a job, thought that employers going to take care of them every single year. And we're now seeing a lot of people realizing that's not taking place. All right. Now, I want to go over some of the myths out here that a lot of folks that start businesses. I get this. This is my number one question, or the number one questions I get every year from folks about starting, who just started a business, who just got that 1099. Or I get clients and they email me, and I get this in my inbox on my website. Must I have a corporate entity structure, or do I have to have an LLC or S corp? Typically what people tell me. I didn't start my business yet because I got to go get an LLC. I got to go get an S corp set up or started up. So once I do that, I'll start my business. Well, that's one of the first myths. Remember I told you, you have a business when you get a 1099. All right? Even if you don't get a 1099 and you start working on doing some things, you get income from somebody. Let's say you have a shoe shine stand and you receive income. The IRS requires you to report that income if you make more than $600 in a taxable year. You're supposed to report that income. That's what the tax law says. Do most people do? Probably not, but that's what the tax law says. So you have a business. Anytime you making or creating income from the sale of your products or services. All right, so I like to just always, I'm one of those guys, I'm about evidence. So let's look right here. Next thing, before I go there, let me show up something. Another question I get first is, do I need an employee identification number? I don't have an EIN number. It's not required to have an EIN number. So what I want to do is populate this last one right here. I wanted to show the screen just to show you. This is the application to apply for an employer identification number. First, what's an employer identification number? Employer identification number is just that. It's an ID number, just like your social security number for your business entity. But hold up. My business entity, as you see here, there's one that says sole proprietor individual. You don't have to have a limited liability to have a business or a trust or a state or a partnership or a corporation or S corp or a church donation type thing. You don't have to have these types of entities to consider to have had a business. I can get one as a sole proprietor as an individual. There you go. So having an employee identification number is nothing that's required, but you get it if, for instance, as a sole proprietor individual, you want to get paid or you have employees. Because as a sole proprietor business, which means as an individual, the only time you're required to have an employer identification number is if maybe you have a DBA, which is called a doing business as. Let's say you called your business Deluxe Representatives, Deluxe Representative, period. Right? It's not an LLC, it's not an S corp, but you're doing business. So John Doe doing business as Deluxe Corporation. Not a corporation, but you call it Deluxe Corporation, even though it's not a corporation. So you get an EIN number because if somebody pays you a check or make you a payment to Deluxe Corporation, you're not going to be able to cash that check unless you have EIN number, because that's the only way the bank will cash it, because your entity has to have its own number. Or if you have employees, if you have somebody that you have to give a 1099 to, then you have to have an EIN number, because your EIN number has to go on their 1099. So then it's required for you to have an employee identification number to go on their 1099, because you can't put your social security number on their 1099. So that's why it's required for you to have an employee identification number. All right? So you got the different business types out there: sole proprietor, LLC, S corp. Really the difference between the businesses is, are you individual? Are you a partnership? Do you have multiple members? Do you want asset protection? There's all types of different reasons out there why you want to have one of these other business structures out there. But the point I'm trying to make here with today's call is that you do not have to have a structure, a corporate structure, where you got to go register with the Secretary of the State to have a business and get it started and going. You can go out here tomorrow and start a business. You might want to go down, get your EIN number, which is free on the IRS website, or you can get you a business license, or it might be some requires in certain cities and states to get a business license, but typically they're very inexpensive, somewhere between $15 to $50 to get a business license, not much at all. So looking at that to your regional district, but the whole point I'm trying to make here is it doesn't take much to start your business. Come up with your idea, start your business. If you need to get one of these structures, then definitely go from there. If you need help, that's what we do at G&G Associates. We help those folks who have those questions, and we have consultant service, and we have hourly rates, and we help individuals with that stuff. All right. Next thing, record keeping. This is the number one reason that most businesses fail. Not because you don't make enough money. Number one reason statistically is the number one reason is because most people do not keep good records. The number one reason most businesses fail. Because what happens is, as I told you earlier, those folks who have 1099s don't realize they have businesses. Guess what they do? They paid more taxes than they probably should have. Well, that extra money could have went back into your business to help grow your business, but you paid more taxes than you needed to. And trust me, IRS is not going to tell you the deductions you can have. You have to figure that out yourself, or get some assistance with someone who can help you figure it out. Or those who making money in their business don't pay the right amount of taxes. They don't pay their estimated taxes, whatever the case may be. That's record keeping. So those are the two main reasons that most people fail when they come to that record keeping. Either you pay too much in taxes, or you don't pay enough in taxes because of your income, and then you end up paying penalties and fees and all the other stuff that comes along with that. And if you get yourself jammed and don't know what's going, it's hard to sometimes get out the hole if you don't go and get assistance. And sometimes, depending on how much money you make in the business, that assistance can get costly. So definitely that education piece is going to be very important to you. One of the things we do that I have on G&G, one of the things we do at G&G Associates is we have a lot of free business development tools on the website. All right, I got business expense organizers to help you out. Again, you go back to the website. Let me see. You go to the website. Under the section here, taxes, tax consultant forms. You'll see the different tax consultant forms that'll be allotted to you. Some of the forms I wanted to show you, some of the new ones. Let's go over the monthly expense organizer just right quick, just to show you the monthly expense organizer. You can download this form. Coming here, this basically what I've done is created a spreadsheet for you to help you with your business. You can pull it down for free. Just download the form. It's an Excel spreadsheet. I've already done the formulas for you, so you can download, keep track of your expenses here. As you can see here, I got it in here with the different months that you might apply. It's got a spreadsheet. Just click on the different months for the spreadsheet, like a January, February, March. You just input it in the yellow section, and then as you input it into the spreadsheet, you just automatically reverts back over to it'll automatically revert back to the main spreadsheet. It'll go back to the monthly totals here. So as you input it during the, oops, I don't know what happened there. All right, as you input it back into the yellow section, it automatically calculates over here into this main page, because this is all your tax preparer needs, the totals. Your tax preparer doesn't need all your receipts and all your expenses there throughout the year. And then also is on here is you can keep track of your mileage for your vehicle and stuff like that. So these monthly spreadsheets is a way for you to track your expenses if you want to do it this way. Majority of people are probably on this phone have smartphones. You know, there's tons of apps out there that are free that can help you with keeping track of your business expenses. Just make sure when you get one of those apps that you're able to download that information to your computer, because you're going to need that for your tax preparer when you do the taxes. Your tax preparer is not going to have access to your app. So whatever you get, just make sure you're able to download into a spreadsheet or a Word document or a PDF document of some sort, so that that person who actually at the end of the year is going to actually do your taxes can be able to use that information to assist you with completing your tax return when it's time to do your taxes. One of the other thing, that's the monthly expense organizer, where we also have the weekly expense organizer on the website that's free. So the weekly expense organizer is just what it is. A lot of questions I get all the time, do I need to keep all my receipts? No, absolutely not. The IRS is very clear. You do not need to keep all your receipts. But people think they need to keep the receipt. The IRS rules say very clearly, you only need to keep a receipt if the receipt is more than $75. Yes, $75, except for lodging. That's the only time you got to keep the receipt regardless of what the cost is. But other than that, you only have to keep the receipt unless it's more than $75. But what is required is you have to keep a record, a log of that expense. And that's what this weekly expense organizer does. It helps you to take those receipts. What I do typically, I don't log them in every day, but I typically log my receipts in at least every 2 or 3 days. I put it in my wallet. I put it on my desk when I get back to my office or whatever. And then later on, maybe 2 or 3 days later, I'll come in and I'll log it in to my spreadsheet, wherever that expenses is. At the end of the month, I have my bookkeeper who now inputs that data into my QuickBooks app that I use. I mean, my QuickBooks program that I use, and it automatically calculates my running income and expenses right there for me. Those of you who may not have that many expenses might not need to do QuickBooks or anything, but they do have QuickBooks, which is a great app. QuickBooks Self-Employed you can find on your app store on your mobile device or your iPad. QuickBooks Self-Employed is very good. It has the same thing. You can download the app, put that expense, it automatically calculates for you. But I just gave, for those of you who don't have that, who like to do the manual things, here's a free weekly expense organizer there for you. And as I showed you earlier, you take that weekly, the 4 weeks or 5 weeks if you're in one of those months, you transfer that to the particular month, January, February, March, April, May, for each month. Keep that log into a separate file, and now you have it, and you have this monthly expense organizer that automatically calculates it for you at the end of the year, and you give this form. That's all your tax preparer wants, is this form with the totals for all your separate expenses. Real simple. All right, these are some free guides that's out there to assist you. Definitely take advantage of that if you want to be able to keep track of your business expenses. Next thing, one of the biggest expenses out there that most people don't take advantage of, or when they take advantage of it, don't do it correctly, is the vehicle expenses. All right, let me go back. Vehicle expenses. This is a great app. I've been using it now probably about 5 years. When I went to one of my annual IRS tax conferences that I go to, this company, Miles IQ, they're on the App Store as well. They were at the seminar, and I started using it, and I have been wishing I could find something like this. And, of course, I wish I came up with the idea, because they're a multi-million-dollar company now. They came up with an app that tracks your expenses. So it tracks your vehicle movement. So you download the app to your phone, It tracks your movement. So just like if you go over speed over certain miles per hour, it knows you're driving. So it's going to track your expenses. You can log it. You have multiple vehicles. You have different things you're doing. You're going on errands, entertainment, personal expenses, medical expenses, all the different things that you're able to deduct your mileage for. It tracks it. You swipe left, swipe right, personal, left, personal, right, business. It tracks it. At the end of the month, week, day, whatever you want, you touch one button, it announces you a spreadsheet to your email address. You can get a spreadsheet in Microsoft Excel. You can get a PDF document, your choice, what you choose to get, and all that is free, part of your app. And now you take that and you're able to use your totals to figure out all your business miles. And so that's very important. One thing I wanted to talk about miles that I forgot to talk about earlier when I was over the vehicle. Well, earlier when I showed you the spreadsheet is it's very important that every year you keep track of your mileage totals. All right. So I usually send out an email to my tax clients, and I tell them, don't forget at the beginning of the year, I always send them, don't forget to log the total mileage on your vehicle. Why is that? Because it's needed on your tax form. It's asked total mileage that you drove in that vehicle for that tax year. That's business and personal. When you keep in a spreadsheet I showed you earlier with this Miles IQ app, it's tracking your business miles and personal miles as well. Because when you fill out your tax forms, the questions on the IRS tax form is how many miles does so and so drive in this particular vehicle, total, business and personal, and then how many miles did they drive just business? Because that's going to help determine your business usage of that vehicle. Because there are multiple ways for you to deduct the vehicle expenses for your vehicle. I'm not going to go over both. That's outlined much so in the publications I gave you earlier. One right here, publication 463 and 535 earlier talks about it as well. It outlines it very clearly how to keep track of those expenses, and I would say definitely go back and look at that because that's a huge expense. Think about it. If you drive, and I like to show my clients this and then how big an expense this could be. Let me pull up my calculator right quick. Let's see if I can pull that up. Well, I don't need to do that. If you drive, and for instance, 10,000 miles is easy math. I would like to use easy math. If you drive 10,000 miles on your vehicle, and the standard mileage rate for 2016, and 2019 now, the standard mileage rate, let me pull it up, for 2018 is, 2019 is 58 cents a mile. Is right there. That's a $5,800 tax deduction. So if you drove 10,000 miles for business in that year, and I know some folks, I got clients who are truck drivers, who are delivery folks, who are Uber. If you drove your vehicle for 10,000 miles, you can see in those type of careers, it's very easy to see somebody driving 10,000 miles in a taxable year. That's a $5,800 tax deduction for you. So definitely take advantage, keep track of those miles, especially if you have those type of vehicle expenses like that, so you can make sure you legally keep track of that and do it correctly. Miles IQ, if you want a 20% discount, I can send you I can give you a 20% discount by forwarding it to you on the Miles IQ. Just send me an email to taxes@gngassfc.com. Send me an email said, please send me the forward so I can get my 20% discount on the Miles IQ, and I just forward you that link so you can sign up for it and get that 20% discount. They actually give it free for so many, and it's not that much. I think it's maybe $5 a month, or you can pay and get a discount or something like that if you pay it all at one time for the entire year. It's definitely worth it, and again, it's tax deductible. All right. So in a nutshell, what's the difference between a tax consultant versus a tax preparer? I want folks to really understand this. A lot of folks go to tax preparers, and they don't realize that tax preparers understand tax software capabilities. They don't understand tax rules and tax laws. I think now you're seeing basically how I went through this presentation. I'm very familiar with the tax rules and tax laws. That's the difference between what a consultant can do for you. A tax consultant can, when you come at the end of the year and you owe so much money or you get a huge refund, can actually show you, calculate it for you, and actually tell you how to save that money or how to get extra money back or to reduce your taxable obligation legally. Give you some suggestions and strategies to help you do that. All right. Myself, as I told you, I'm a tax and financial consultant. I can show you on both sides of that. How can you best take out your investment without having a big taxable obligation? This is one of the things I get every single tax year. And I tell clients, give me a call before you make that move, before you take that money out that 401k, before you sell that property. Give me a call, because those are events that could lead to taxable obligations for you. Give me a call. Let's talk about it. Let's have a consultation, go over it to save you from maybe making a mistake and paying more taxes than you need to every single year. And it's too late when you come to me on the tax season, because if you come in the tax time, like right now, it's January, and you did the sale back last year in 2018, it's too late. We're in a new tax year now. Even though we're doing taxes in 2019 for 2018, we're in a whole new tax year. So there's very little you can do from some of these investments and sales at this moment. And of course, majority of clients don't do their taxes. I'm not saying majority. A lot of clients don't do their taxes on time. They get extensions and things of that nature. So it really, you pass the deadline. If there were any possible hopes of doing something, the deadline may have been April 15th, the year of the tax season that you're actually doing. But, so definitely if you're having some situations where you might think you might have some taxable obligations that might be owed or due, I would say consult your tax consultant and get in touch with them to see if you should do this, how could you do this in a way to limit your taxable obligations so you don't pay no more tax than you need to. All right? Because there's a lot of tools and credits and things that's out there, or strategies that you might want to take it all now. Maybe you might want to exchange if you got a rental property sale, exchange it, like kind of exchange. There's all types of opportunities out there and things that you could possibly do to reduce your taxable obligations. All right? All right, so you're almost about the end of this presentation, about to wrap things up here. All right, so 2000 tax return preparation season is upon us right now. All right, I'll give you a shameless plug. Yes, G&G Associates, we do tax preparation. If you want to get your taxes done, we can assist you. There's our website, gngassociates.net. Previous clients, you get a 25% discount. That's previous clients for anything, any service you use with G&G Associates. That's taxes, financial, and VA, veteran claim assistance clients. You get a 25% discount as well. So that's there allowed for you. New clients get a $40 discount. Just, mention you was on a webinar, or you read this webinar, you listened to the webinar, and then you'll be able to get a $40 discount. Anybody you refer, you get a $40 discount as well. I forgot to put that on here, but if you refer somebody to G&G Associates, because we have a very good referral policy, you'll get a $40 referral fee for anybody that gets their tax preparation done by us. And we guarantee to match or beat any other tax professional price. Guarantee. All right? If you choose to come to us to get your taxes completed, on our website, we have our 2018 tax preparation worksheet under the same link that I showed you earlier where the tax forms are at. Just look for this right here, 2018 tax preparation worksheet. Or you can email us at our taxes@gngassoc.com email that you saw earlier right here. Or you can just go to the website and go to Contact Us page, request a tax preparation worksheet, and we can send that to you via email as well. I suggest if you want to do that, I try to prepare audio message to help you so you don't waste time coming to the office, mailing in things, electronically sending them to us, whichever option you choose. We have clients all over the world, literally. I have clients on 5 continents and all over the United States that come to get their taxes prepared by us. So we are very internet and technologically savvy, so we can get and assist you with your taxes anywhere in the world as you're located. I would say definitely listen to the audio message to assist you on how to do that. One of the things and big changes the IRS is really being strict on, especially with the increase in tax fraud and identity theft, is they're requiring that a valid government ID be issued with the issue and expiration date be given to prepare any tax return that needs to be e-filed. Okay, understand, e-file. If you mail it in, of course, you don't have to have that. But if you're going to e-file it, in order to be e-filed, you have to have a valid government ID to be issued for expiration with the issue and expiration date. If you're one of those tax folks on the call and you are going to be taking advantage of any of the tax credits, that's the child tax credit, earned income tax credit, educational tax credit, you must fill out an additional tax credit worksheet now. That's very important, because there's going to be some questions on there to make sure that you meet the category to be able to take that deduction. Basically, kind of like a truth or dare. I'm not lying. This is me. This is my child. Stuff like that. So you definitely have to fill out that tax credit worksheet. That's in part of my tax preparation worksheet at the end. If you're not going to be claiming any of those credits, then I'll fill out that part of the worksheet. But if you think you might, definitely fill it out so there don't be any delays in getting your tax preparation completed, tax returns completed. Again, this new rule is to combat the IRS tax fraud and identity theft situation. And of course, if you are sending your stuff in electronic and you're worried about security, your ID, we have secure upload capabilities. You just email us the same contact information if you want us to send you secure links so you can upload your data. If you want to send your stuff to it, we have that capability as well to securely send you. The capability is just to upload your documents and to be secure and protected and encrypted. All right. Make sure you sign your forms for your taxpayer and your spouse, and if applicable. That's the most important part if you want to get your taxes prepared by us. All right. Now we at the question and answer session. I got a few questions from folks that were sent in. If you got any questions or anything I covered at this time, please send it in to the number down here. I told you, 757-271-6068, and I will do my best to try and answer that question for you. All right. So one of the questions I got, what if I underestimated my income through the marketplace for health insurance? Will I owe? Is it still a requirement to have health insurance? Yes, it's still a requirement to have health insurance. And for last year, if you underestimated your income, you possibly will owe, because that's still following under some of the rollover to 2017. I will tell you they're working on that to try to eliminate those tax penalties and things for 2019, and that's one of the things that's still in flux at the moment of how they're going to handle that. Because as you know, the current administration that's in the House, the White House, they are totally against the health. But they call it the Affordable Care Act. I don't call it Obamacare because it's not Obamacare. It's the Affordable Care Act. They're totally against that, and they're trying to do everything they can to kill it. So they're constantly trying to figure out ways to kill it, and this is part of what they're doing. Their proposal is try to eliminate those penalties and stuff. But if they eliminate those penalties, then people are not going to have the health care, and that's going to try and kill it. So. But to answer your question, yes, you will probably have maybe some type of taxable obligation if you underestimate your income, because your health insurance is based on the income you estimated. So if it was over such that income was over that, then you will have a taxable obligation. All right. Hopefully that answers your question. Next question I got that I commonly get from individuals is hold on. My app closed down. One of the questions I commonly get from individuals is, what is and I kind of went over it earlier, that what is the difference between standard mileage and what's the difference between standard mileage and they call it the auto. It's basically dealing with your vehicle expenses. Standard mileage versus actual cost method. I guess somebody maybe was looking at the books when they went through that. I'll go just a little bit more detail. Again, you can go back to the publication and tell you the difference between standard mileage and the actual car expenses is, regardless of the fact, remember I told you earlier, you got to keep track of the total miles and you got to keep track of your business miles regardless. And the reason why you got to keep track of that total miles and that business miles is really for the actual car expense. Even though the IRS asks for both of those, the really determination is for those people who keep track of their actual car expense. Because what happens is the actual car expense method is, so let's say, for instance, you have one of the newer cars, or you have a car that maybe have business interests, or you might be depreciation. Like I told you earlier, had a depreciation expense for the luxury vehicles earlier. You might actually be able to deduct the business usage of that vehicle, because you're probably using that vehicle still for personal usage. So the example I used earlier, if you drove 10,000 miles and you used a standard deduction, and with the standard deduction you had 5,900 miles were business use, you would get 5,900 a $5,900 tax deduction. Well, if you had actual costs, let's say you had a car that had a car note, so out of that, that's 10,000 miles, 5,900 was for business use. 59% of your car note is tax deductible. 59% of the and the car note, I mean the interest part, not the actual car note itself, the interest part. Now, if you leased the vehicle, 59% of the lease payment because you don't own it, so you can deduct 59% of the lease payment, 59% of your car taxes, 59% of your gas, 59% of your repairs, and on down the line. So basically, any expense you have with that vehicle, you get to deduct 59% of that with the example I just gave you. So depending on how much that vehicle costs you, it could be more than the 5,900 I gave you that you would get for standard mileage. What standard mileage uses is it's just giving you, it's encompassing all that in that 59 cents. It's encompassing all those things like the depreciation, the gas, the repairs, the interest, all that stuff. And it's a simplified way for those people who don't want to keep track of all those expenses. So the thing that comes to become more difficult now is if you do the actual cost, you have to keep track of all those expenses. So you really need to have an app. You really need to be keeping track of your expenses on a weekly or daily or a weekly basis because it's going to get tough for you to try to remember how much gas you put in your vehicle 6 months ago. I can tell you that right now. So you definitely want to have some assistance with an app or something. So every time you go get gas, you can just dial it in your app and it tracks it for you. All right, or you definitely want to use something like MileIQ if you're going to try to do actual expenses as well. Because even in MileIQ allows you to put in the costs. You can put in your tolls. You can put in your gas. You can put in your repairs in the MileIQ because you can say I went to the gas station or I went to the repair shop to pick up your vehicle or drop it off, and then after the vehicle you picked it up in MilesIQ, you can put the cost of my vehicle repair was $342. It'll put it on a spreadsheet for you. All that'll be there. And you can label it repair costs. So those are some of the advantages of these apps out here. They call them smartphones for a reason. You just got to be smart and use them. That's what I call it. Smartphones mean you got to be smart to use the phone. We all know we got smartphones, and I don't use every ounce of all the capabilities of my phone either. But if we, learn, do some videos, watch this stuff, we can actually take advantage of our smartphones to help smartly improve our businesses and our actually own businesses. All right. Got another question. The next question I got was, hold on here. My thing timed out here just a second. All right, how long does it usually take if you send in your information to us that we get your tax return? It all depends. If you send in your documents to us, as for tax preparation, if you send in your documents at April 15th or 2 weeks prior to the tax deadline, it's going to take longer. So definitely, the earlier you get your taxes into us, the sooner we can get them back to you. Our aim is to get them out, to get them looked at and in within 72 hours. That's our goal. So, of course, that 72-hour window expands the closer we get to the tax deadline. But early in the tax season, that is something we can definitely get in and out for you. Now, do remember, if you're one of those folks who are going to be doing those tax credits like earned income tax credit, child tax credit, things of that nature, even though you file your taxes now, the IRS is going to hold on to those until like the middle to end of February before they release their refund, because that's one of the high tax fraud and the identity theft situations or things that occur in those type of credit. That's why they're asking for the extra information now. As a matter of fact, I forgot to mention as well, if you have going to be claiming those credits, especially for the child tax credit or the earned income tax credit, you have to actually now provide that Social Security card as well, or a copy of the birth certificate to go along with not just your government ID. You got to have the Social Security number, Social Security card, and or birth certificate for that dependent. The tax preparer has to see that, or the tax preparer is subject to penalties. And I'm not trying to pay the $500 penalty for you, so I'm going to be asking for that information so you can go ahead and make sure you send in that information right away. All right? See here. All right. Oh, I got a good question. I always get this a lot too, in reference to Business use of your internet and your phone. Very good question. And this is one of those. It depends on what type of business you got, especially when it comes to the internet. If you have a online business, then you can deduct 100% of your internet. You can't have a business without the internet. That's your business. You have an online marketing business or a website and things that you're using that business, and that's how you get your clients. Then you can deduct 100% of that cost of the internet. Now, you can't deduct. Sometimes I see a lot of clients that try to deduct the cable because, you have a lot of these companies now that try to do your combination packages of cable, you get your phone, your landline, and you'll get the internet all combination. So what you have to do then is, if you look at that bill breaks it down for you, the difference between each one of those packages. So you got to take just that portion out of that package for the internet. Now, if you use that landline as part of your business line, then of course you could deduct a portion of that landline. You can't deduct 100% of the cost of that phone, especially if you use that phone for personal usage. Now, if you use that phone and it's a dedicated business line and you got a home office, then yes, you could use that phone as a business expense. But you got to deduct it based on how you use that phone. 100% use, then you can deduct 100% of that phone call. But if you're using that phone line as a personal line, you can only deduct a percentage of that phone line. And I don't want to get into big particulars on how you come up with that, but just and it's in the rules. They give you examples in those IRS publications, as well as those paid books I gave you earlier. That's on Amazon.com. On Amazon.com, they give examples of how to keep track of that. But just think of it this way: somehow you got to be able to show an auditor with the IRS how you came up with that calculation. Like for me, my cell phone use, I use 90% of my cell phone uses for business purposes. I pretty much use my cell phone all the time to communicate. So 90% of my cell phone is I use for business purpose. But you might not work your business as much as I do. I'm working my business. I'm self-employed. I work my business 7 days a week, all day, all night almost. So I use my phone quite often, but you might only use yours 50%. So that's where you have to determine that number. You got to be able, if you ever get audited, to make sure that you can be able to explain to an auditor with that. And that goes to my next question. Good question. The question's coming in now. Okay, it popped up. Next question I got was, it was dealing with, and these are real common questions. I'm glad that folks are asking. Somebody had a tax preparer that said they shouldn't take this expense because it's red flagged. It could be a red flag or flagged to the IRS. Well, this is how I always like to answer this. First of all, let's talk about what audit proofing is. All right, audit proof does not mean you do not get audited. All right, that's first. Let me explain that. What audit proof means is, if I ever get audited, the IRS, your uncle decides, your unfriendly uncle decides to audit you, you have the proof to support your audit. Okay, that's what audit proof means. You have the proof to support that audit. So when I told you earlier, record keeping is very important. I think somebody might have fell asleep on the call. I tell you, that's what taxes do for you, y'all. They put you to sleep. But you had a proof to audit. You have the proof to support your audit if you ever get audited by the IRS. So that's why that record keeping becomes very important. If you keep track of your records, and you can now show an auditor your receipts, how you track this receipt, how you came up with the totals on your tax return, you now have audit-proofed your records. I tell people all day, if a tax preparer is telling you, you might not want to deduct this because you might create a red flag for the IRS, they're telling you one or two things. Either they think you lying, and you probably don't have the documentation to support that expense, or I would tell you they're not feeling comfortable taking the deduction because they didn't probably understand the deduction themselves. So that's when you definitely need to get somebody who's not a tax preparer, or even if you got a consultant, get somebody else who's not a tax consultant. Somebody should be able to show you the proof of how you can take the deduction. My thing is, I'm trying to take every deduction I can legally take. The thing is, do you have the documentation to support that deduction? As long as you have the documentation to support that deduction, take it. Don't let somebody scare you into taking something that's legally there for yours. Your job is to go back and look at some of those publications I gave you earlier, learn how to properly take it, keep track of it the right way, and then you have no fears at all about whether you should or shouldn't take it. All right? All right, well, that looked like that was our last question that I had. If anybody has any questions from this point on, feel free. You remember I told you can email us at taxes@gngassoc.com. You can visit our website at gngassociates.net. Go to the Contact Us page, and you can send us an email through there. We're on Facebook. Definitely follow us on Facebook, Instagram, LinkedIn. Definitely become a fan of us there. I always like to send out a lot of educational information. I send out educational information quite often to try to let you know what's going on, keep you up to speed with what's going on in the tax laws, financial, and from the veteran side of the house. So definitely befriend us there and send it out to all your friends, family, co-workers. And if you thought this was a great presentation, definitely let them know about this. I will post this onto the G&G Associates website, this presentation for today, so you can go back and listen to it again and send it out to your family, friends, and co-workers. And look forward to hopefully maybe assisting you with your taxes or anything from there. You can also join our free newsletter on our website at gngassociates.net. You can go right on the home page. If you want to join the free newsletter, you can join that, or you can even join our financial monthly newsletter that I have as well. That's a paid subscription, and you can get more details with that. One of the last things I wanted to tell you also with being a tax client, one of the things, if you get your taxes prepared for us, you get a free 1-hour financial consultation, which is a $200 value there. So you get a free 1-hour financial consultation with us if you get your taxes prepared with us during the tax season. All right? All right, God bless. Everybody have a wonderful night, and thank you for showing up.
Thank you.